Welcome to another episode of Taking Stock for the week ending the 8th of May 2026. I'm Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz. And just before we begin, a reminder that today's discussion is general in nature and won't consider your personal financial situation. Now, also, we're excited to announce our upcoming masterclass event in Sydney and Melbourne next month. Matt, it's going to be very exciting, isn't it?
It sure is, Ken. It's going to be an action-packed day. We're going to be talking about appropriate asset allocation, particularly in this highly volatile environment. We're going to talk about how you use ETFs most effectively, geopolitics and the Iran war with some expert speakers that we've brought in. We're also bringing in an expert speaker on the AI disruption thematic and how you can see some opportunities potentially in that landscape. Plus, we're going to have a full recap on how to get the most out of Stock Doctor as usual.
Yeah, it's going to be a full day event, action-packed as you mentioned, and also along with a lot of insights there. So make sure you don't miss out on that one. But Matt, along to the markets, they've had a lot of volatility this week, hasn't it? Oil prices fell sharply on reports that the US and Iran are moving closer to a potential peace deal, only for that to be cancelled last night. So what's going on here?
Yeah, well, look, it was certainly the narrative yesterday that they were approaching some sort of an off-ramp, but overnight, as you just mentioned, that we've seen some exchange of fire between the US and Iran in the Strait yet again. So the situation obviously remains highly volatile. But if were to take that glass half full approach, a normalization in energy flows would help ease pressure on inflation and provide some relief for corporate margins. But despite this, the RBA still lifted rates this week, just 4.35%. And Governor Bullock made it clear that bringing inflation under control remains the priority.
Yeah, locally here we are struggling with inflation, aren't we? And that brings us to this confession season. We're seeing more companies downgrade their guidance over the course of the week. Examples include packaging company Amcor and building materials business James Hardie, not surprisingly there as well, given they're in the building construction where costs are quite paramount. And we also saw gaming companies like Light and Wonder and our retailer as well, Super Retail Group, they also downgraded their earnings guidance.
Yeah, exactly, Ken. And this is the kind of market where investors need to separate genuine long-term opportunity from businesses where the earnings base may need to be reset. Share prices may have fallen, but that doesn't automatically make them attractive.
Yeah, good point there, Matt. And that's been a key issue across the retailers. Now, consumers are still spending, but far more selectively. We've seen like-for-like sales growth. That's slowing across much of the sector. We've seen increased promotional activity as well, and retailers are beginning to absorb that higher costs, higher freight, wages, and inventory costs.
Yeah, that they are. And JB Hi-Fi also announced an update this week at the Macquarie conference, and they mentioned that supply chain constraints and rising technology component costs, particularly in categories exposed to AI-related demand for memory and chips. Management noted laptop prices have also risen materially in recent months, while stock shortages are becoming more common.
Yeah, it is quite divergent in terms of the sector kind of stocks here. Businesses with stronger brand positioning or value perception, they appear more resilient. Whereas, when you're looking at companies like, for instance, Sigma Chemist Warehouse, JB Hi-Fi, and also Universal Stores, they were able to maintain their double-digit growth, especially Chemist Warehouse as well. They continue to benefit from this defensive demand and market share gains because of their value proposition.
And as you mentioned there, by contrast, discretionary and high ticket categories are seeing far more pressure, particularly where consumers can delay their purchases. Super Retail Group was a very good example of this. Management noted weakening consumer momentum across much of the portfolio, with BCF, boating, camping, fishing, the most impacted division as customers pull back on outdoor and recreational spending.
Yeah, assessing, and this is where we assess those risks and make sure that you are and you're fully aware and understand how much exposures you have. But moving now across to infant formula producer A2 Milk, we made the decision to remove the stock, and while the company still has a strong brand, the investment case is now more challenging.
I think that's right, Ken. The issue here is visibility. A2M has been through upgrades and downgrades in quite quick concession this year, and that makes management credibility hard to assess. When guidance changes too often, investors start questioning whether the business is genuinely predictable or whether earnings are driven or being driven by short-term channel conditions.
Yeah, and the share price has been kind of tumbling, but even after that, I mean, the stock is still trading on around a PE level of around 23 times. And that risk reward appears to be less compelling now because you're paying a reasonably full multiple for a business with declining returns. You've got reduced visibility and a more uncertain outlook here as well. But also, an interesting update this week came from former Star Growth stock, logistics software business WiseTech. The company reaffirmed their guidance. Earnings revisions have started to improve now, and growth is expected to accelerate, especially in financial year 27, which is encouraging given that there were concerns about supply chain disruption and AI competition.
Yeah, that there has been, right? I mean, all of the software stocks have been belted, so it's really encouraging to see that they're going out there and reaffirming their guidance. And management is leaning heavily into this AI thematic and using AI as a productivity tool rather than treating it purely as a threat. And importantly, CargoWise remains deeply embedded across global logistics networks, which creates a meaningful competitive advantage.
Yeah, and we spoke about that a few months ago when we did our roadshow on AI. But many analysts believe that the stock is relatively cheap, but investors need to be comfortable with the risks, which remain quite elevated here. You've got the E2 open integration, which is a major execution task. Also, those governance concerns around Richard White, they're still persisting and short interest. I noticed that that's still about 7.5%. And for Under the Microscope this week, let's take a look at gold producer Vault Minerals and its proposed merger with Regis Resources. Now, at face value, this is a logical deal. You've got two Australian gold producers combining to become the third largest ASX listed gold producer behind Northern Star and Evolution.
And sifting through the detail, the rationale appears to be scale as opposed to operational efficiencies. Gold producers are often rewarded for being larger because they attract broader institutional ownership, greater index relevance, and potentially a lower cost of capital.
And for Vault shareholders, though, the offer is around 0.6947 Regis shares for each Vault share. So that implies roughly a 10 to 11% premium to its last traded share price. And Vault shareholders will roughly own around 49% of the combined merged entity if the deal goes through.
The strategic logic, as you mentioned, Ken, does seem sound, but the premium looks modest, especially if gold prices remain elevated for the foreseeable future. Vault was already trading at a significant discount to fair value and at around 6 times its forward earnings.
Yeah, so we've got a few questions from our members. What should investors do here? Well, for existing Vault shareholders, there's really no need to rush. The deal is subject to approvals. Completion is expected to be around August or September, and there may still be optionality here.
And that optionality, I think, is really important, Ken. A higher bid is possible, particularly from Genesis Minerals, which already operates around Leonora, where Vault's King of the Hills and Darlow assets are also co-located. So combining the two would unlock far greater operational synergies. Given this, Genesis could be prepared to pay more for the assets, with some analysts believing a 20 to 25% premium is warranted.
Yeah, very interesting there, Matt. And also, that all depends on this gold outlook as well. Gold has already had a strong run last year, so much of that easy upside may now be behind us. While it should continue to benefit from inflation and geopolitical uncertainty, we've just got to watch how bond yields move from here because if they start to ease, that should help support the gold price. And with the confession season in full swing, a topical question this week is what should investors do if a company issues a profit downgrade?
Yeah, it's never a nice feeling, Ken, but the first point is not to assume the downgrade is isolated. Earnings downgrades often come in clusters because management teams are naturally optimistic and tend to lower expectations progressively rather than all at once. If pressures around demand, costs, or margins do persist, further downgrades can quickly follow.
Yeah, that's right. Especially in this environment where earnings visibility is quite low. But that means that the first downgrade should trigger a review. Investors need to ask whether that problem is cyclical or structural. Is it temporary? Is it just a short delay, like a delay in customer purchases? Or is it the business model which is losing pricing power or competitive advantages?
And the most useful test is to rebuild the thesis from scratch. If you didn't own the stock today, would you buy it now, knowing what you know now? So if the answer is no, holding just because the share price has fallen can become an expensive form of hope.
Yeah, don't let your emotions take hold there. But also, what's important is financial health. Downgrades are more dangerous when debt is high, cash flows weakening, or covenants are tight. Management credibility and earnings visibility also matters here.
And for those after a more objective approach, you can use the ST30 TSR combined with negative earnings revisions as your exit trigger.
Yeah, and if you're still unsure, remember to call and speak to our team of analysts or our customer client servicing team. But that brings us to the end of this week's episode of Taking Stock. Matt, I appreciate your insights and time. I know how busy you are.
It's been my pleasure, Ken. And look, in this market, discipline and stock selection is obviously key. The opportunity set is improving, but so is the need to avoid businesses where earnings visibility is clearly deteriorating.
Yeah, very wise words there, Matt. And until next time, have a happy, healthy, and prosperous week ahead.